Good to see you guys. Again, I apologize. Everyone can hear me okay? Hi, Danny. Hi, FX Street. Sorry about that. Thank you for the email, the heads up there. I assure you it'll be worth the wait. Great markets. Actually, today kind of a slow day because you have the FOMC today. So, Carlos, the Cardinals fan. I'm a White Sox fan. I'm an American League guy, so I don't mind the Yankees. Okay, we're good to go. Improve your trade selection with pattern and direction. The one thing we need to add for next time, it's almost important. Pattern and direction are most important, but when you understand it's the cycle, there's really a 2.5 to 3 day cycle out there in the markets. It's very important that kind of cycles through the patterns, and that's really, we've been focusing on that a lot too. But we'll touch on that next time. A reminder to you that trading involves risk of loss and is not suitable for all investors. The techniques I demonstrate are proprietary and should not be retaught or retransmitted for any reason. And again, good to see you guys. Now, Carlos, you're from New York. You cheering for the Cardinals to knock somebody out? We have kinfolk downstate that are Cardinal fans. My name is Jay Norris. I'm a 20-year trading floor veteran of the Chicago Board of Trade. I've written a couple of books on trading, which were published by McGraw-Hill and serve as the textbooks for our courses. This second book here outlines the methodology that I'll be, the tactic I'll be showing you today. And here's our third book. This is a great book. I wish I would have written this one first. Very short book, very inexpensive compared to the textbooks, but nonetheless probably the most valuable of them all. That risk tolerance threshold theory really states it all. I mean, basically what we talk about is how the boom-bust cycle has been replaced by the impulse-reactive cycle. And rather than have a full boom-bust cycle where the market goes up and then goes all the way back down, you don't have that anymore. You have the market goes up a big time and then it will retrace, somewhere around 2/3, and then you have a new move is born. There's a lot of things behind that. Obviously, the 401k cycle, people are obviously have gotten a lot better at managing their money. So literally, you don't have boom bust anymore. You have impulse reactive. So bear markets don't last as long, and we're seeing that in stock indices, et cetera. So this is a fascinating material and a lot of technical material too. It's really going to help you focus on which markets to trade and when to trade them, et cetera. And I'm watching dollar yen out of the corner of my eye here because I want to do something there short term. I'm going to cover this really quickly too. Why do most retail traders not succeed? It's not something we talk about a lot in our own trading. Here, 1 second while I pull up a chart here. I'm keeping an eye on something. It's not necessarily something that we focus on in our own trading a whole lot, just because we'd rather focus on what works, right? But as far as we don't, most of you guys, we don't really know you. You're not our students. So if we can give you something of value that's not going to get you in trouble either. I mean, when you're teaching trading, you have to be very careful what you show people because you can't just show them one little tactic and not explain how that works. So if there's something we can give you that's worthwhile and that can keep you out of trouble, that'll be great. And for our perspective, that's going to be pointing out why people lose. A lot of different reasons. Number one, they don't fully understand the risk that they're taking. Well, more to that, a lot of people, they just don't naturally have the patience or the discipline or, the education really is what it comes down to. But really on a more simplistic basis, they don't understand risk. They don't understand that, okay, if you say you're going to risk $100, then you have to risk $100. So many times we see with people, they'll go, okay, I'm going to risk $100. And rather than risk the $100, they get they're out $60-$65. They say, I can't take it. Let me get out of here. Get out. They cry uncle, right? They exit the trade. Well, what happens then is you could say you're going to risk $100, but by not risking that 100, when it gets to 60-65, you panic out of the trade. You exit because you didn't understand your own risk tolerance. What happens then? You exit that trade with a $65 loss. Guess what happened? You got out at the bottom. The market turns around and you watch it go for 3 days in the direction you anticipated it going in, right? You didn't understand your own risk tolerance threshold level. Okay, so you have to understand that when you're trading, you're going to take risks. You have to. I mean, trading is all about taking risks. You could get in that trade, you could follow the method, and it could turn around, stop you out. It can make one more high, knock you out, and then you're going to be asked to get right back in that trade. How many times has that happened to you? You get stopped out, it turns around, you get another signal, but you're like, I don't want to take it because I just lost, and then boom, it goes your way for another 3 days, right? But only you're not in the trade. So you have to understand your own risk tolerance. And we cover that in our courses extensively in not just trading psychology, but trading philosophy. And that's another thing. Most people don't have that, risk tolerance threshold theory in itself is a philosophy. It's my philosophy. Basically, that's how professionals view things. You got to have that. So you have to have that right philosophy, and that runs deep. You have to have the right method, but before you can have that method, before you have the courage, the patience, the discipline, all that stuff to trade that method, you have to have the correct philosophy behind you. I mean, the philosophy could be something as simple as, okay, I know how the market makers operate. I know that their job is to knock me out of trades on the high or the low, so I'm going to be patient and I'm going to wait for them to knock everyone else out, and then I'm going to get in my trade. That's a philosophy in itself. My philosophy, I happen to believe that markets are fractal based, so fractal geometry of philosophy. But I don't want to bore you. Most people lose money because they don't understand risk. They underestimate their own tolerance for risk. Number two is their premise is wrong. Okay. In trading, you've got to have the correct premise, okay? To me, my premise is always that markets are fractal in nature so that they're going to be repetitive and that they're going to make sense. They're going to make sense from a longer-term perspective, okay? Fractal in nature means you can break them down into different categories. Sure. This is a dollar, and I'll tell you why I was excited. I've been excited about buy signals at this level right here, and that probably has still me being a little late there. I like taking buy signals against this level. Why? Because different patterns are aligning and telling me that, yeah, I can see that this maybe this ThreeDay pattern happens to be bearish, right? Or you could see it if you go back several days, you can have a bearish pattern there. Yet at the same time, when I measure the market to get the critical patterns in the yen, my 20 days up, my 50 days up, etc. So yeah, the 10-day may be down, but if I'm a short-term trader, I'm really not concerned so much of that 10-day as long as I have the 50 and 20 are up. So that's what I say. Markets are fractal in nature, and that you can break a market down in any time frame you want, and you can measure that pattern. And based on those different patterns, you're going to have a pretty good idea on how that market's going to react. Now, today, not the best example because you have the big FOMC number today, get an FOMC, so no one's going to commit to anything big ahead of that. So you're kind of just looking at, quiet counter-trend trade day, though, that's a good time to take a little bite out of the market, though. So back to the screenshot. Why most people are wrong is because they're wrong. Their premise is wrong. You have to have the right premise. I don't even know what a wrong premise. I don't know what an example of a wrong premise would be. You could say that, okay, I think that the dollar is going to strengthen because the Fed's going to stop tapering. Well, that may be true, but that premise may be over a longer time period. And if your premise is based on something fundamental you think is going to happen, that can take politics being politics. it can take a long time for these things to happen. And if your premise is too long term, then you can get smoked on that too, right? So your premise not only have to have the correct premise, the correct philosophy, but it's got to be appropriate for the time frame that you're going to trade. And this is the biggest one. This is the easiest one to correct. Why do most people, traders, not succeed? They don't understand the importance of using market-generated setups and signals. You have to it's not me that's going to determine when to go long or short. It's the methodology. It's the market itself. And here's an example of that this morning. This is a market-generated setup and signal forming. Okay? I have my support line drawn. I get a nice little double bottom. See how the market, see how these little moving averages, that short-term moving average cross pops up, and that's my signal. I have a trend line, short-term trend line break. What I call a change of direction, meaning the lowest price is closed above the high of the lowest closing candle right there. So trend line break, change of direction, and then a moving average cross. See my moving average cross turned up. So that's a market generated buy signal right there. Okay, it's telling me to go long here at 98.92 or so. Put a stop at 98.86 or so. So what? 92 to 86 pip stop. So if I'm going to risk 6 pips, I'm happy taking 9 out, right? Because I'm going to happen to go with a 1.5% risk reward. That's reasonable. Okay. If I'm risking 6, I'm looking to get 9, right? So when I get my 9, I'm happy. I take it. I'm not greedy. I risk 6 to get 9. Or maybe ideally I put 3 on, take 2 off at 9 pips, let 1 go with the break even stop. That way if it keeps going, I'm in there. If not, it's no great shakes. But my point being, I didn't make the determination to go long here. I'm going to pull the trigger, but I'm pulling the trigger to go long right here because the market told me that there was support here. Okay, I'll draw exactly how in real time. Okay, see that band of support there between the purple line and the green line? If I double bottom on or in that zone, I can take that as a trade. So that's what we call market generated. And then the market itself had to change direction. Momentum had to shift in order to give me the signal. So I'm not just buying blindly at this level. I have a pretty good idea you're going to have support here because I also know that, again, the majority of patterns are bullish for me. Here's my yen ratio. So what my yen ratio is bullish. So if I'm a day trader, I'm just focusing on these 3 short-term patterns, the 50, the 20, and the 10. If the majority of those patterns are bullish, which they are, 2 out of 3 is bullish, then I'm looking for buy signals. So when I get that retracement into my zone, all things being equal, I'm going long there. That's a nice little trade. That's a nice little buy for the day. Right now, on a futures contract, on 3 lots, that's $375 on a 3 lot. Right? On standard Forex contract, that would have been on a 3 lot $270. So yeah, that's light, but it's not, and that's an ideal little setup to go with on Fed day today, on a day where you're not looking for big moves because it's Fed day, right? No one's going to make a big commitment ahead of big news like that. Fed day, unemployment day, generally. You'll see, these are such big numbers that the market will slow down in Europe and the U.S. session just out of respect for Fed day. So, this is a nice little market generated setup today that we were working on. And the bottom line is, my point being, is the market generated. It's a market generated setup and signal. So all these things most people get wrong. They don't understand their own risk tolerance, meaning if they say I'm going to put a $50 stop in there, guess what? The price goes about $30, $35 against them. They stop themselves out prematurely because they don't understand risk. Why don't they understand risk? They don't have the proper method. Their premise is wrong. So you have to understand risk. You have to have the method, and your method better use market-generated setups and signals. And by having that proper method, you're going to see over time what your winning percentage is, what your win-loss ratios are, etc. And we teach all that And we teach it in live markets too. I mean, we really go beyond the call of duty as far as working with our clients in live markets to teach them all that good stuff. Now, it's back to trading method. You must have a robust trading method which works in all environments. And there's no doubt about it. And it better be relatively easily explained. Now, you may not have to be able to explain it easily right away, but 3 or 4 months into studying it, you should. But who's ever teaching you that method should be able to explain it to you pretty simply, pretty easily, right? And for my money, the method, the best method, if you're working on a method or you're studying a method, it needs to combine the mechanical framework that is, the mechanical framework should always be the same. It should be very easy to figure that out. To calculate that, it should be as simple as, it should be as simple as an equation. It should be the same all the time. We use the mechanical framework to determine we determine pattern and direction, which markets to trade and which directions to trade it from. Then you need to have behavioral aspects to it. Behavioral aspects are going to help you manage a trade through the news cycle, when to enter the trade, how to manage multiple contracts, when to exit the trade. That's all behavioral. So mechanical is going to help you which market to trade, which direction to trade it from. Behavioral aspects will help you with when to enter and exit the trade, how to manage the trade. Behavioral aspects, it's not your behavior, it's the market's behavior. So the mechanical framework is black and white. 1 + 1 always equals 2. 2 + 2 always equals 4. That's pretty simple. The behavioral aspect, that's based on the market's behavior. So it's not what you think. It's not what you feel, that's for sure. It's based on the mechanical framework to point you in the right direction, and then the behavioral aspect to show you how to manage that trade. Here's a great example of the behavioral aspect. See, moving averages cross. They cross here. They uncross here, right? So you get in here, you get out there. It's based on the market's behavior. What we teach is by far pretty simple stuff. The problem is people are going to complicate it. Okay, people, they're always looking to, villainize someone, like the market maker's the bad guy or the broker's the bad guy. It is what it is. I mean, I don't look at it good or bad or anything. I mean, it just is what it is. No, I don't. Sunshine? That's a good question. No, it's not based on the moving average. A moving average is just a secondary measurement of price. It's a lagging indicator. So at times, a moving average may look like it provides support or resistance. No, I don't use those longer term moving averages. The pattern is based on a retracement. It's based on math. It's very, very simple. Very, very simple. Read the book. Here's Sunshine. The book, The Secret to Trading, which is a pretty heavy book. I mean, it's short and everything, but most people get it though. But if you want to know how to determine the pattern here, to me, this is the best $6 you could spend on a book, on a trading book. Here's the book. And here, rather than go into that, it's always the same though. The pattern, it never changes. I mean, how we measure the pattern will never change. The exact levels, I keep it proprietary, but it's pretty simple. It's extremely simple. When you say it's not an indie, I don't know what that means. That's not But anyway, that book will answer that question, Sunshine. It's $6 US. No, it's not an indicator. I could pretty much do it with the naked eye now, and it takes me all of 10 seconds to figure it out. No, it's definitely not an indicator. It's based on Dow Theory, actually. It's definitely based on Dow Theory. Dow Theory is a great book. The Dow Theory would be the book. And here's where maybe this will help you too, Sunshine. Yeah, it's $6. That book is well worth it. The method that we teach, it acknowledges the different time frame patterns in a market. And here's how we break it down: 10-day, 20-day, 50-day, then the secondary and the primary. The secondary and the primary, they're taken directly. Secondary, primary, day to day, they're taken right out of the Dow Theory. And we focus on markets with low non-systemic risk and look to trade at those times when the day-to-day news flow is aligned with the primary or secondary pattern. Here's how an investor or a longer-term trader would trade. Here's how we trade primarily. Well, there's a couple of examples of it, but here's how we trade now, primarily as day traders. We look to trade at those times when the micro patterns are aligned with the day-to-day news flow and trade around the intraday news releases. So we're really focusing on those short-term time frames. Here's really what I focus on right now. It's just like in the yen, I'm just focusing on these three. And whichever way the majority are pointing, to me it's insignificant the 10-day is down because the 50 and 20 are still up. If the 20-day shifts, then the majority of patterns are down. Then 2 out of 3 are down. Then I'm looking to sell rallies. But as of right now, I'm still looking to buy dips. And I happen to like if I get dips to these levels, I happen to like that level. But there's nothing going on right now ahead of that FOMC business today. So pretty much everything's on hold. So it's a good day for learning and teaching, not necessarily trading. And these are just charts. It shows the advantage of trading with that day-to-day. Here's the gold. Long before gold market collapsed, the day-to-day pattern was down. So really all you're looking for short-term trend line break. You draw a bull trend line when it breaks, get short. Bull trend line when it breaks, get short. Bull trend line when it breaks, get short. Same thing, get short. And, you just keep doing that. Trading's all about repetition. Bam. Here you may get short here, but it's going to come back against you. Let's say you took that short-term trend line. That's why you want to get out of a trade based on your risk. Get out of a portion of that trade. Then if it comes back and stops you out on the other one, at least you put money in your pocket. But you want to focus on a market. If the day-to-day pattern is down, look, if your 15 or 20-day are down, which is the case on this chart, you had more than that. You had your secondary, your 50, your 20. If you have a market where the majority of patterns are down, just keep drawing bull trend lines and get short when it breaks the trend line. It's that simple. And here's the Aussie dollar where you can see the repetition. And that's all it is repetition. The patterns just repeat themselves over and over. Zone. It gets to the zone, get short. Gets to the zone, take a bull trend line break, bull trend line break, bull trend line. I mean, it's pretty simple stuff that markets just repeat themselves over and over again. And that's, markets repeat themselves because we repeat ourselves. And markets are really just a reflection of what we're doing, right? What we're buying or accumulating. And it's even repetitive down to the intraday time frames and intraday patterns. The market makers, they just play the same game over and over again too. So all the professionals know that markets are about repetition. So when you get in a market that you're making money, just keep doing the same thing. That's what professionals do. They do the same thing over and over and over again. It's pretty interesting. I was looking at the market last night. I was up last night, and I was seeing how people just trying to get short down here. They keep trying to get short down here, short. And I'm like, at some point they're just you just want to get long because they can't get it short, right? They're getting it short, and I don't know what the market makers must have been luring them in below 15 here, and then they just trap them. And you're seeing it. It can't go. This is last night in Tokyo. It's not going to go. It's not going to go. To me, I understood it wasn't going to go because while you may have had, it may have looked bearish short term because the pattern's bearish on very short term. The pattern itself is still bullish here. Despite that 10-day being down, the 20 and 50-day, you're not going to see a big move down ahead of FOMC. No one's going to commit to a breakout ahead of FOMC. So I'm just watching this last night. I'm thinking I should just trade it. But I'm pretty disciplined. It's time for bed, et cetera. But I was just watching them. It's not going to go down. It's going to go up. And then sure enough, it went up, right? Then once they do take it up, once they get everyone long, then they can knock it back down. But no one's going to commit to a big move here ahead of the FOMC, right? But it really is repetition. I mean, markets are all about repetition. And this is a great quote by my friend Bill Williams. And I really don't have time to go into this because I got the late start. I apologize. I better keep moving. Great question, Sunshine. Number one. No, you can throw out the patterns on when you have a big news release. They're not going to do you a whole lot of good. Here, I'll give you an example of the patterns, how we view them. Okay, here, you guys have heard of that 3-day pattern in the currency, probably. You get it. Currencies are pretty reliable. Okay, I mark Fridays with orange. I don't generally trade on Fridays because Friday tends to be a counter trend day. Thursday into Friday is a tricky time to trade. Right? You can see it here just in here. Okay, Thursday, Friday, the market on Friday, then Monday, Tuesday, Wednesday. Okay, Thursday, the counter trend move. Friday, it's like sad counter trend. Let me close my email, and I apologize, Vicky, that I'm late like that. Counter trend Friday, Monday, Tuesday, Wednesday. So you can see just have a tendency to have that 3-day pattern, right? Here again, Monday, Tuesday, Wednesday. There's your 3-day pattern. Consolidate over the weekend. Today, now, yesterday it looked like you were starting a nice 3-day pattern too, right? Markets open up down here. They end up closing higher. Again, you're buying dips and uptrends. It's making sense. But then today, it looks like the pattern is broken. Well, the pattern's really not broken. You just have that number. So the market's slumped, but this pattern still remains bullish as long as you're that, essentially, as long as you're holding that pattern of higher lows, the pattern's still bullish. So the pattern's not broke today. It's slumped ahead. You had a counter trend slump because it's a big, you have the big news later in the day. So wouldn't surprise me if this market ends up here. So there's your 3-day pattern. 3-day cycle. So hopefully that answers your question, Sunshine. That the time to just not trade because you know that the patterns and the cycles aren't going to be there is on a big news day. Dhruv, no, I don't want to get into that. I don't have time for that. And that's one of the main things we teach, too. And again, here's a great example. Why don't most traders succeed? Even London quant hedge funds reported 2 years of losses in a row because they're not heeding Bill Williams' advice that you have to, and Bill wrote the book, my good friend Bill wrote the book Trading Chaos. You have to focus on you have to use linear. You got to focus on nonlinear chaotic techniques, okay? You have to let the market organize itself. Most of us think chaos means craziness. Chaos means an extremely orderly system, but you don't see it because your mind works different. For us, something orderly is different than how nature is ordered. Like we may see a hurricane, we think that's crazy, but actually, the hurricane, there's definitely an order and a flow to it, right? Maybe that's not the best example, but just because we can't make sense of something right away doesn't mean it's not ordered. So chaos is actually a higher order. So to me, you have to let the market organize itself and then recognize it. You can't force. You're not going to go in there and think, I'm going to figure out what's going to go on in the economy, and then I'm going to bet on that. It's going to work. It doesn't work. Okay, you have to let the market order itself. Once you let the market order itself, then you're in good shape. And here's how I would define trading chaos: employing a method based on fractal geometry and embracing the understanding that markets are scalable and these scaled patterns are repetitive. I got to check the clock. Yeah, I'm running short on time, so I better just speed up and get to the meat here. You don't need all that. You need to know when direction is aligned with price pattern. That's going to be the key for you. And here's how we do that. I really have to define direction for you. This is key. Direction is a trend line break plus a directional line shift. And that's just obviously on one. If you could do that on one pattern, you could do it on all, right? On one time frame, you could do it on all. Now, pattern's key. Drew, pattern is absolutely key. It is that simple. It's that simple. Once you know what I mean by pattern, then you're good to go, because then you can piece them all together. Directional line is defined as the low of the highest closing candle in an uptrend or the high of the lowest closing candle in a downtrend. Directional line is key. Okay? That's your trigger. And we use the direction line if price is closing below the direction line, direction is down. If price is closing above the direction line, direction is up. And it doesn't matter what time frame you do it on. So the change of direction equals a reversal. Here it is here. It's a trend line shift plus a directional line shift. And remember I said, here you want to write this down, the low of the highest closing candle in an uptrend or the high of the lowest closing candle in a downtrend. That's a critical area on the chart. That's how we determine when directions in fact change. Here's the highest closing candle right there. Mark the low. The low of the highest closing candle, that's a significant point. When you close below the low of the highest closing candle and the trend line, that's a reversal. That's what we call a change of direction. That's a reversal. Here it is again. You close above the high of the lowest closing candle and the trend line, that's a reversal. Now, that signal, that reversal, what we call a change of direction, it's only significant if it's in line with the patterns or the majority of the patterns. So that change of direction is going to be critical for you. The key is taking that signal in line with the pattern, or the collective pattern is what I call it. And here's the price pattern. Price pattern pretty easy to eyeball. It's the higher lows and lower lows, right? Higher lows, lower lows. So obviously you'd be interested in that. You're looking for a change of direction in line with that pattern. Here's the U.S. stock market. You're interested in a change of direction in bullish pattern. And here it is. There's the change of direction. In here, take these away. See, this is the lowest closing candle right there. So when you close above the high of the lowest closing candle, that's a shift. In line with a bullish pattern, that's bullish. Okay, right here, same thing. You have an uptrend, you have a correction. Once you close above the high of the lowest closing candle, then you have a signal, then the pattern's going to continue. So, and these are all, we essentially use the pattern as a trend map. And you see I keep track of the patterns here. If the majority of patterns are up, and these are longer term too, that's your secondary, your 40, and that 20-day, which we used to eyeball the 20-day on a 60-minute chart. So we used to call it a 60 micro. Now we call it just a 20-day pattern. So we use we use the patterns as a trend map. Okay, so I better wrap it up. I apologize I'm late. Come and see us next time, and we'll take our time. And I'm going to also introduce the cycle in here too. And here we're showing you the same thing. This is a weekly chart. So you're just focusing on that low of the highest closing candle in a downtrend, and you're using that to get short on. So, hey, we think if you're interested, you like what you see, come and see us at Trading University. We're unique in the business. Yeah, the patterns. Yeah, Drew, definitely get the book, because that's really going to determine in the book. In the book, we use the 618 level as the line in the sand. We use a proprietary number. It's a little bit greater than that, but 618 will work great for you, too. Yeah, it's all in the book, Drew. And the book is only $6 US. But our course, we're unique in the industry that we give you access to everything up front. We give you our entire coursework. We let you attend our master's course in live for $199 a month. Now, it's a 6-month program. If you stick with the program for 6 months, you pay $199 every month for 6 months. You're in the program for life, okay? You'll have access to everything we have for life, okay? If you don't like it, if you pay $199, you get access to our core concepts, our advanced concepts, our graduate course, and the archives of all our master's courses, which are taught in live markets. You get access to everything. If you don't like it in that first month, you're not going to continue to pay, right? It's up to you to whether you pay us or not. You're going to pay us per month, okay? If you don't like what you see, if you get in there for a month and you go through all the courses, you go through 24 hours of videos and probably many more than that in there. If you go through all the videos and it's not making sense to you right away, I tell you don't pay. Quit the program, okay? But if it is making sense to you and then you decide you go month to month, at the end of 6 months, you don't have to pay anything more. You're a member for life. So come see what we're doing. You're risking 200 pips, right? 200 mini pips or 20. You're risking 20 standard pips per month. And if it works, believe me, you're going to love it. If not, you're certainly not going to continue, okay? And we've never had anyone that just came in there for a month and left. Never. So it's up to you. We're unique in the industry in that it's got to be worth it for you to continue to pay that, right? So if you want to know, you have questions about the course or what we're doing, here's my info. Let me know. And there's my Skype. Thanks, everybody. And there's my info if you want to know more about what we're doing. Stay out of trouble today, though. You got that big number, the FOMC, so I don't think there'll be anything going on ahead of that. Thanks, everybody. We'll see you next week. I'll double-check my calendar, too. I thought it was an hour earlier than I anticipated today. Okay, thanks, everybody. See you next time. Thank you, Sunshine.